Times they're a-changing. That's what Bob Dylan said. And whilst he may not have been describing the revival of fixed income pension products in 2022, that is what we're currently seeing. Guaranteed retirement income products are enjoying a bit of a renaissance, and it's not hard to understand why. Investment values have fallen across the board this year, which always reduces the general appetite for risk, and the guaranteed rates of income being paid have recovered to levels we haven't seen for well over a decade, as we can see here. Many people still discount annuities entirely though, because they lack the flexibility and they lack the death benefits of drawdown. But there may be one or two things you're not aware of when it comes to certain types of annuity products, which could mean they're far more flexible than you think. So what I want to do in today's video is first address the downside of fixed income products, or at least the perceived downside of them. Then look at the case for them if those obstacles can be overcome. I'll then talk about a certain type of plan that aims to bridge the gap between the flexibility of drawdown and the certainty of an annuity to give you the best of all worlds. If you've landed here for the first time, I'm Chris Bourne. I'm a financial planner based here in the UK, and I've spent the past 18 years or so helping people achieve tax-efficient early retirement. My videos are all very much focused on that, so if that's the type of content you're looking for and you haven't already, hit subscribe, turn on those notifications, and with all that said, let's get into it. When George Osborne introduced the bombshell pension freedom reforms in his March 2014 budget speech, it was like driving a train through the annuities industry. For the first time, people were going to be able to draw their entire pension pots as cash if they wanted to. And for those who wanted to leave their pension pot as a legacy, the punitive 55% tax charge on lump sum death benefits was completely removed. In one fell swoop, it made the idea of purchasing a product where your income was restricted and where you'd lose any remaining value to the provider upon death seem about as attractive as mud wrestling with Boris Johnson. From the end of Q4 2013 to the end of Q2 2015, annuity sales went down over 75%. To be honest, this theme remained pretty much unchanged all the way up until this year. But as is often the case in life, things go in and out of fashion. With so much flexibility in pensions now, it does sometimes seem that we've lost sight of the fact that the main purpose of a pension, for most people, is to provide a stable income in retirement. The ability for a pot to still grow in retirement and to leave a tax-efficient legacy for the next generation is definitely useful, but not usually the primary aim. I've created hours of content about how to make investment sustainable in retirement and how to improve confidence in your drawdown strategy, like in this video from a few weeks ago. But sometimes the best solution is the simplest one. For a lot of people, the notion of not having to worry about underlying investment values, fund charges and spending guide rails at all would be quite refreshing. And that option does actually exist in the form of an annuity. It's an insured income for life, regardless of how long you live for. However, we can't simply ignore the fact that traditional annuities do mean losing control over how much you're able to withdraw, and do mean having to choose, and essentially pay for, death benefit options like spouses' pensions, without knowing for certain which spouse will be the last survivor. For me though, the even bigger problem with annuities is the cost of purchasing an inflation-linked income. I recently obtained a quote for a client who was offered a level annuity, i.e. one that doesn't increase, of £22,500 a year. If we added RPI inflation linking to it though, the annuity offered dropped by £8,500 to just £14,000 a year. Now sure, if you lived a long life, the income would eventually catch up and overtake, but the crossover point, where the inflation-linked annuity would finally have not just overtaken the level one, but have paid out the same amount of money in total, was projected to be more than a couple of decades into the future. That's why there needs to be another way. And fortunately, there is, in the form of fixed-term annuities. There are some great possibilities with these that I think really can give you the best of all worlds. There are a couple of providers in this space, but I'm going to provide illustrations using Legal & General's fixed-term annuity. It's not a specific endorsement, they're not sponsoring the video, but they do have a pretty good online quote system that you can play around with. First of all, what is the purpose of these plans? Well, they exist to let you choose a guaranteed amount of income for any period between 3 and 25 years, or 3 and 40 years if you go through a financial advisor, without having to tie yourself into the same annuity rate for the rest of your life. They also allow you to choose a guaranteed maturity value at the end of that fixed term, which you can use to either go into another fixed term plan, purchase a lifetime annuity, take it as a lump sum payment, or even transfer to another pension scheme of your choice, i.e. you can go back into drawdown. So what that essentially means is that you can access all of the security of an annuity for a period of time. You can know for certain what amount of money you're going to get on a monthly basis, what amount of money your plan is going to be worth at the end, and you don't have to lose control of your death benefits. If you choose a guaranteed period for the full term of your plan, your beneficiaries will still be paid the income you were getting if you died, and still receive the guaranteed maturity value, which they could transfer into a pension of their own as well. For me, the major benefits of this, aside from those that I've just stated, are that you're not locked into the same annuity rate forever. You don't benefit from any rate rises after you've purchased a lifetime annuity, but you still can with a fixed term annuity, because you're able to renew when it matures. We know that annuity rates generally improve with age, but we also know that our health deteriorates. You might be healthy when you first purchase a lifetime annuity, but if that situation changes, you're not compensated in any way. Taking out a fixed term annuity gives that flexibility back. Choosing death benefits on a lifetime annuity is a lottery, because you never know who's going to live the longest. A fixed term annuity gives that flexibility back. The example case studies in Legal & General's Key Features document also illustrate that you can even withdraw lump sums during the chosen fixed term, which don't affect your income payments but are just deducted from the final maturity value. I love these Key Features guides because they always include helpful pictures of retirement, which apparently should consist of hill walks with a local women's institute, or maybe a bit of kayaking for the slightly more daring retiree. The only picture they seem to be missing is the classic early retirement couple walking down the beach with their jackets casually tossed over their shoulders. But apart from being inspired by those aspirational photos, what do the figures look like? Well, like all guaranteed income products, they've improved a lot this year. Let's assume we have a 65-year-old male who wants to be paid a guaranteed income for 5 years. Let's also say his pot is worth £200,000 and he wants it to still be £200,000 when it matures. What amount of income would he get? Well, with an income guarantee lasting the entire term and payments being made monthly in arrears, he'd get £867.31 a month, or £10,407 over the year. That means that the guaranteed value of this plan is £252,038. L&G are given £200,000, they pay a total amount of income of £52,038 over 5 years, and then they give back the £200,000. £252,038. That's the same as getting a guaranteed return of 5.2% on your money, net of all costs. Yes, there may well be investments that return more than that, but none of them will guarantee it. And we all know that the sequence of returns makes a big difference to the amount of capital we're left with, not just the average return. This type of plan removes all of that risk. You might even be willing to forego a little bit of your capital in order to access that guaranteed return. What would happen if we settled for a maturity value of £180,000? Well, it has the effect of pushing that guaranteed income up to £1,158.52 a month, or £13,902 a year. So you can immediately see how this could be useful in your planning. If you were reducing to part-time hours at work, for example, and wanted guaranteed income replacement up until you fully retired. Or perhaps if you wanted to bridge the gap between when you take early retirement and when a guaranteed defined benefit scheme or your state pension kicks in. When those things start, they're often able to do the heavy lifting from an income perspective. So you may just want to stabilise things until then, and then regain flexible access to your capital afterwards. You could even look at a new fixed term annuity quote at that point and say, I only need £500 a month for my £200,000 pot now. What kind of maturity value would I get from that in 5 years' time? Well, on the same quote basis we used before, the guaranteed value would be £225,227 at the end of that term. Quite a healthy return that you can rely on. So as you can see, there are options out there that can blend together some of the best aspects of lifetime annuities and other more flexible income options. And they take away some of the concern around inflation because you can adjust for that upon maturity. One important thing to note is that these plans would trigger your money purchase annual allowance, just like Drawdown would. So you'd be restricted on what you can pay back into pensions up to a maximum of £4,000 a year rather than £40,000. There's quite a lot to take in there, so I'll just mention that rates can sometimes be better when going through an advisor rather than directly, so it's worth checking that. It's also still important to have a plan for sustaining capital in retirement when you're not using guaranteed income products. So I'd recommend watching this recent video next, if you haven't already, because I go into a bit of detail on how to do that there. As usual guys, I hope that's been helpful, and I'll see you soon.